Friday night, right about this time, we bring you the Power Seat. My guest today is Alex Cook. He's the Chief Executive Officer of Wealthbit, a South African Fintech focused on making financial planning more accessible. Under his leadership, Wealthbit develops free tools like the Tax Snapshot and Compare Your Options calculators, and delivers its financial freedom program to employees through their employers. With a focus on financial wellness, Alex works to help South Africans understand and optimize the parts of their finances that often go unnoticed. Starting with tax. He believes tax is one of the biggest levers in a person's financial system, and that greater clarity around it can reduce stress and help money work harder towards long-term goals. Wealthbit's mission is to make the invisible parts of people's finances visible so more people can achieve financial freedom. Alex, good evening. Welcome. It's Friday night. Hope you had a great working week.
Tich, amazing to be here. Thanks for inviting me. And I didn't realize your channel Africa was so widely distributed.
Hey, in 54 countries, my brother, including the diaspora.
That's amazing.
At the right station.
Flipping amazing. Well done.
And we're going to talk about my favorite subject, Alex, tax. So you said...
Don't lie. It's no one's favorite subject.
You got me there. So you say tax is the largest annual expense for most South Africans. Why do you think people pay so little attention to optimizing it compared to things like rent and groceries?
I think because it just happens automatically. It happens automatically. It comes off your payroll, and you get the net amount, and you just figure, well, that must be right. But there's so many more things you can do. So this is all already a big part of helping people get towards financial freedom. If they have more free cash flow left at the end of the day, what that means, they can put that towards sort of areas of their life that can help them achieve financial freedom. So yeah, people don't pay much attention to it, I think primarily because it happens so automatically.
Yeah. So what is the real cost of just accepting SARS auto assessment without checking it? So people should actually look at the pay slip and check to see how much money has gone to government, right?
They should check it, yeah. Then they should get some counsel afterwards. SARS is one of the best run government organizations that we have. They've automated a whole lot. They've made it really easy for the man in the street to log on, man or woman in the street to log on and actually do their taxes. But you might be missing out on certain deductions that you are eligible for, such as medical credits, such as optimizing towards your retirement funding by putting a bit more towards your retirement funding, whether the government effectively gives you money back for investing. So there's so much more that can be done. If you're a sole proprietor, a lot of your expenses are incurred in the production of income. In other words, you spend money to make money, and that money you spend to make money, you can deduct off the amount of tax that you have to pay. So much can be done.
Yeah.
I don't think a lot of people spend a lot of time worrying about it. And one of the greatest investors of all time, Warren Buffett, he had a partner who recently passed away, Charlie Munger. And Charlie Munger talked about the value of businesses. And often when you value businesses, you look at something called the EBITDA, which stands for earnings before interest, taxes, depreciation, and amortization. And he always said that was a load of nonsense because taxes are real, depreciation is real. So you can only value a business after you pay those things. And a person is very similar to a business where you can only work out how much you actually earn after you pay tax. So look, worrying about how much you earn before you pay tax isn't as valuable. So yeah, but Tich, this is really just one part of one of the levers of financial freedom, and there are a few others which we could go into if you've got time.
Yeah, cool. Now, one of the things you said was, for the average person, one would want to know what the 4 key factors that determine how much tax need to be paid. What are those 4 key factors?
Well, one of the first ones is how much are you earning? How much are you earning? That'll then put you into a tax bracket. You then would need to work out what your actual taxable income is. So from your gross taxable income, you've then got to deduct all of the deductions which you're eligible for. One of them is contributions. Another one is medical tax credits. Another one, if you're on a commission basis, may be expenses incurred in the production of that income. So if you're a salesperson, you may be spending money to make money. A lot of that can get deducted from your taxable income. You then get towards a net taxable income. You then apply that towards the tax tables, and then from there you deduct your rebates. And depending on your age, you get primary, secondary, and then tertiary rebates to then work out how much tax payable actually is. And then depending on what your income looks like, you might be a provisional taxpayer, in which case you need to submit your tax returns at the end of 3 periods. The first period is the end of August, and then the end of January or February, and then the end of September is your third provisional. So it's not that complicated, but it's complicated enough that the man in the street wouldn't necessarily be able to take maximum advantage of all options they have available.
Mm. So that's where you guys come in, right? You got
Well,
an automated
that's
system.
where coaching comes in. That's where coaching comes in. And if you look at every single professional sports person, they all have coaches. If you look at every single
Yeah.
wealthy person out there,
Mm.
every single one of them has a coach. They might be called a financial advisor, but effectively they're a coach. And we believe coaching is absolutely necessary for us to get more people towards financial freedom.
Yeah, Alex, I want to find out about something that you mentioned a moment ago. Medical tax credits. Do you want to explain that? If I have, you know, some kind of credit insurance, if I don't go to see a doctor, do I get my money back?
It's all about how much you're contributing towards your medical aid, and based on how many dependents you have, you then get a certain amount of medical tax credits against the tax you're actually paying. So medical tax credits are a very powerful form of tax deduction, and get the total amount that you're eligible for over a year is quite significant for a person with two people in their medical aid. They could be deducting as much as 8,700 Rand per tax year in tax credits, and these are applied directly to the tax. So it's almost acts as a primary rebate off your taxable income. So it's powerful.
Yeah. Which deductions and credits are most underutilized by South Africans?
So I think the medical tax credits are certainly one of them. The other thing that we see fairly often is where medical expenses get really high. There's an additional tax credit, medical tax credit that you can claim, and you need to keep very careful records of all the expenses you've incurred, all the medical expenses you've incurred, including your medical aid contribution, and then look at that as a percentage of your gross income to then figure out whether you're entitled to deduct even more off the amount of tax that you pay. So that's one of them.
Mm.
The other really big one is on retirement funding. So most people, I think the average retirement funding in the country is around 12%. So 12% of people's income goes towards some form of retirement funding. Usually it's a provident fund or a pension fund. The maximum amount you're allowed, though, is significantly more than that. It's actually up to 27% of your taxable income with a cap of 430,000, which is up from about 350,000 last year. So the average person won't reach that cap. That's quite a high cap, but 27% could be put directly into a retirement fund where you can do a voluntary contribution, or you can put the money into a retirement annuity. Both of those are deductible. So just to make the maths easy, let's say you earn 100 Rand, you're allowed to put 27 of that 100 Rand into a retirement funding vehicle, and you won't pay tax on the 100, you'll pay tax on 73 Rand. So you end up paying a lot less tax. Often this pushes you into a lower tax bracket, which means you pay a lot less tax. So what the government takes or gives, eventually they take back. So one day when you get to retirement and you start drawing an income from that retirement funding, then you will pay tax on the income. But what usually happens is that you can get your income to a lower tax threshold, so you end up benefiting. In fact, we've always seen people benefit from that structure.
Wow. 27% is a lot of money over time. I like that.
It's a lot of money. It's a lot more money than most people can afford, and it's actually not the first priority. So on a financial freedom journey, the very first priority that we recommend people take is to first figure out what they want their life to look like before they do anything else. Figure out what you want your life to look like, and then put a plan in place to achieve that life. The first part of the plan is actually doing a budget. So figuring out what you earn, and then make sure that what you spend does not exceed what you earn, and there should be a little bit left over. Then start building up something called an emergency fund. And emergency funds are so important, because if they're not in place, what usually happens when that emergency, and I had one of these emergencies last year. Last year, my son, he fell, he chipped his tooth. My partner went over a pothole. She destroyed the one tire. So that was expensive. Then my son went out playing again. He chipped his tooth again. So we went back to the dentist. So it's one of those Novembers from hell. It was expensive. And if we didn't have an emergency fund in place, guess what? We would have swiped the credit card, gone into debt. That would have taken a while to get out. So having an emergency fund is critical. And this is, I'd say, more important than starting to contribute extra towards a retirement fund. First, get a budget. Second, get your emergency fund in place. Once that emergency fund's in place, then start looking at killing some debt. And I'm not talking about debt on your house. That's debt on an appreciating asset. You know, the house is going up in value. But debts on clothing, food, credit card, get those debt items kind of squashed as quickly as you can, because as soon as you can become debt free, at least on everything except for your largest asset, which is your house in most cases, from there on you're actually pretty free, and you'll be amazed at how quickly you can start saving. And then start worrying about putting money into sort of tax effective vehicles like retirement annuity or extra contributions towards your pension fund. And then you can start optimizing for capital growth.
Hey, Alex, how come I've never heard of this? I mean, I've been to school, university, they never talk about this.
Jeez, Tich, it's crazy. So, I mean, I'll tell you my story just very, very quickly. Yeah. I started a financial services business when I was 21 years old. And I started there for the main reason that we had to put food on the table. The family wasn't in a wonderful financial situation. So at the age of 21, we started this business. And for the first 6 years, I really thought that money was the big driver in my life. I thought that, you earn another rand, you end up being happier, and life would be great. And then at the age of 26, I was by no means wealthy at all. But what I did realize is that earning another rand also wasn't making me happier. So we started looking around for purpose, and it really came to us all at once about 3 years later. So I guess it evolved over time. But we kept on having people coming into our office, and these were men and women in their 60s. And they kept on saying the same things time after time. They said, why don't they teach us stuff at school? I've had a broker my whole life. Why have I got no money? Why didn't someone tell me earlier life was going to be like this? Because when they came to us, we had to tell them the honest truth that, you've got this amount of money. It feels like a lot of money, but it's going to give you half of the income that you're used to living off. And then they started crying, literally crying. And I remember holding, sort of hugging a few people, and just telling them it's going to be okay, but you're going to have to change your lifestyle quite a lot. We're going to have to bring your family in to come and support you. And we realized that we were in a position to change all of that because finances are not complicated. Everyone makes finances out to be complicated, but they really aren't. There are only about 5 levers you can pull to get your situation better. And they're not complicated levers. The problem is no one sees their finances all together. Yeah. They see little bits. They see their car finance and their car debt there. They see their bank account there. Maybe they see an investment here, but they don't see everything put together. So one of the first things we did when we decided we're going to see if we can change the face of finance in South Africa and hopefully the rest of the world in time was give every person a very clear view of what their financial future looks like. So we put it into a program, and this program is what you mentioned a bit earlier, Wealthbit. And Wealthbit gives a person a picture of not only what their life looks like right now, but if they're to continue doing everything they're doing from now until retirement and until the time they're at the end of life, what does that whole picture look like? And if that's a picture they want, fantastic. If they want it to look better, well, then start changing something now. And on the back of that, we see that behavior changes a huge amount in people, which is amazing. We've got such cool success stories. It's so rewarding to see.
Fantastic. Hey, this is really exciting. We may not have enough time, but quickly, Alex, the Tich Snapshot tool, how does it work? And how does the financial projection for an example, for somebody like me work?
Yeah, Tich, I think I can go into a whole lot of detail in tax, but if you go into the website, you'll find the tax snapshot. But what I think might be amazing is if I do something. I don't even know if I'm able to do it. Can you see my screen?
Okay.
This is a financial snapshot. So you tell me if this is too complicated. So you are, I don't know how old you are. I was guessing you're 47.
That'll do.
So take it. If you're older, take it. So okay. Let's say you're 47 and you want to retire when you're 65. What this snapshot does is it takes real information and it puts it into this program where you can see what happens to your capital over time. It goes up, and then you retire, and then the capital starts going down. So it's problematic. And you can see this in present value or in future value. So just to make this simple, the house that costs 5.4 million today, when you are 65, if you're 47 today, it'll cost 15.5 million. And because this person is looking to replace an income of 25,000 Rand a month, we know how much capital they need. We know that in today's terms, they're going to need 7.5 million. And because at retirement, they only have 5.4 million, they are unlikely to be okay. So what we then do is we say, okay, if this is the situation and it really doesn't look good, how can we make it look better? And this is where one of the gems of the system comes in, and this is scenario planning, where we can change something very simple without even contributing anything extra. We can just put the person into a correct portfolio. We can say, look, your portfolio is too conservative. Your asset allocation looks like this, where you've got a lot of domestic bonds and domestic cash, and that isn't what's going to get you towards a good outcome. If we were to change that, and we had to put you into the correct portfolio, by simply doing that, instead of ending on 5.4 million, you would end on 7.6 million. And instead of being unlikely, you would then be possibly able to retire safely. And this is how simple it is. It's not complicated, but it helps people make decisions with the end in mind, make intentional financial decisions.
Yeah. Hi, Alex. Just because of time, thank you so much. If people are concerned like me, and they want more information, how do they get a hold of you?
Best way is through the website, on wealthbit.co. Also, feel free to pop me an email at alex@wealthbit.co. I'll make sure they get a response.
Thank you, my brother. Have a fantastic weekend. That's my very special guest on the Power Seat. Fantastic. On the Power Seat tonight, that was Alex Cook. Yay, man, you got to watch your money and get in touch with him. he will most definitely help you. This is African Diaries. It's now 19 minutes to 11.